Today we're going to be talking about my investing portfolio. As we get towards the end of the year, I think back to the beginning of the year when I decided to make a drastic change with my investing strategy. For the longest time, growth stocks were the way to be. With 2020 and 2021, with the incredible rebound after the pandemic drop, growth stocks were the place you wanted to be. We got to the start of this year and I started to feel really uncomfortable with having my money sit in those types of accounts. So I made videos talking about how I was making the switch over to dividend investing. And I got a lot of flack about it, talking about how I was buying all the boring stocks while all these other stocks are going to be taken off. Now we're at the end of the year, the stock market is down significantly still, and we're testing previous lows from October and November. This isn't a video talking about me bragging about my switch over to dividend stocks and why I've been beating the overall market so far in 2022. It's a talk about how you need to revisit your investing strategies. Strategies are great, but they're only great for specific times of market conditions. As things change, your strategy needs to evolve as well. So I'm going to be talking about why I made that switch, talk about why I think there's still time for people to make the switch over to more dividend-heavy investing, because it's something I've been talking a lot about on this channel recently. And then finally finish up the video by talking about my top 5 positions that I've added to so far in 2022 and why I intend to add on to them aggressively going into 2023. Currently, my portfolio is down 7%, with the overall market being down 21% for the S&P 500 and 34% for the NASDAQ. We just had a really tough day on Thursday as stocks sold off really aggressively, and we're testing those previous lows from October and November. So are we going to go down further? It's very likely. So far, I'm recording this on Friday morning. Stocks are relatively flat, but I intend to see those lows be broken as we get towards the end of the year and we have some more tax loss harvesting for the last couple days of the year. And there's one simple strategy that is the whole reason why I'm beating the stock market so far in 2022, and that's that I just keep buying stocks. I'm going to repeat it just in case you need to readjust your earbuds or something. I just keep buying stocks. This is the strategy that has been proven to be one of the most successful ways to build wealth in the stock market. That's by dollar cost averaging and consistently adding to positions. For the past couple of years when the stock market's up, it's not as fun to buy into stocks as you are raising your average cost, so that percentage gain that you're going to see doesn't look as attractive. You can have a 100% position go down to a 50% position if you add to it. But as the stock market falls, you have to look at this as a buying opportunity. And that's how I've really viewed this aggressively in 2022 and has really motivated me to add to my positions overall. And this is the reason why 2022 was the most amount of money I've ever invested into my investing portfolio overall. But one of the important things to recognize is that this strategy really is the best when you're buying stocks that are long-term plays. For the longest time, I've been buying really aggressive growth stocks, and as they fall, you go, oh, I love this stock, I'm going to buy more of it. And then as the overall market falls further, you just get further and further into the red. This is an idea of bag holding where you're no longer trying to build wealth from it. The main goal that you have is just trying to break even from your break-even point. You're not even thinking about making gains. You just want to break even so you can get out of it. And as the overall market falls, you have all these videos being made about, oh, this stock is going to outperform the overall market. The problem with a overall market sell-off is that for the most part, these stocks aren't strong enough to resist the downward pull of the overall market. You have some of the giants like the PepsiCo, the recession-proof stocks that have some arguments being made on why they're going to do better. And that's why some of them are actually up in 2022. But for the most part, these growth stocks do not have the type of resiliency to stop the overall market from falling. So as a result, they're going to sell off more aggressively. The beta, which is a way that you can determine how aggressively the stock is going to move relative to the overall market. A number of 1 means if the S&P 500 or NASDAQ goes up or down 1%, it's going to match it identically. A 2 beta means that it's going to go 2 times that move. So these growth stocks are going to be more aggressive. And as a result, these dividend stocks on average are going to be less mobile. They're not going to drop as much. That's why a lot of these stocks that I hold in my portfolio are not down as much as the overall broader market. So when you're looking at the markets falling and specific stocks that you own going down, you need to kind of take a second to think, okay, is this going down as a discount, something that a year or 2 from now I'm going to be really happy that I bought back at this price? Or is there a chance that it's not going to recover as quickly as the overall market and this is something I'm going to regret? As stocks fall further, you can get caught in this way of thinking of how much further can it go down? It's already down 50% on the year. How much further down can it go? The answer is it can go down all the way, and it's really important to try to avoid putting yourself in situations that'll blow up your portfolio. We're trying to build wealth, and the quickest way to stop that growth is by putting yourself in bad situations that you need to recover from. As your portfolio falls down further, you have to make more and more returns to break even to where you were previously. So that's another benefit of these dividend stocks, is they're going to fall not as far, and as a result, they don't need to go up as much to break even as compared to some of these stocks that are down 60% on the year. We have stuff like Tesla is down almost 70%, Same with NEO. These stocks that were the high flyers of 2020 and 2021, they're down a lot, and it's going to take a lot of momentum for them to recover, and I expect them to take a lot longer than the overall market to recover. And then another reason why my portfolio is probably outperforming the overall market has to do with dividend reinvestment. This is the drip strategy that I talked about in the dividend snowball video that I'll throw up on the screen right now. But it's the idea of, as the stock price goes down, in theory, the dividend payout is going to remain the same or hopefully go up. It's a function of the dividend payout over the stock price. So as the stock price goes down, that yield goes up, meaning that it's going to be a more attractive dividend stock overall. This is the reason why a lot of dividend yields have spiked during recessions as stock price has gone down, and it's made it more attractive. You do need to make sure that these stocks are going to be able to pay out these dividends safely. That's why in that dividend snowball video, I talked about why I only buy stocks that have are dividend aristocrats or dividend kings, meaning that they've raised their dividend payout annually for the past 25 years at least, showing that they can survive in various market conditions, and it makes me feel a lot more comfortable as we go into, I feel like we hear unprecedented times, like 5 times a year. This is a good example of having stocks that have been around the block and they've seen pretty much everything, where a lot of these momentum stocks have not really been around for seeing some tough economic times. We have the shortest bear market in the history of the stock market, but besides that, some of these stocks have not seen, the deep dark recessions that we saw back in 2008. So let's go over my 5 largest positions and kind of talk about my feelings on them, and just to show that these are stocks that have done relatively well in 2022, and that's why my portfolio has outperformed the overall market so far in 2022, and why I intend to have those same results going into 2023. So my 5th largest position is going to be PepsiCo, ticker symbol PEP, which is up 3.5% on the year. It's a dividend king with 50 years of dividend growth. This means I feel very strongly about calling this a recession-proof stock. They've been through an incredible variety of market conditions. They've seen high inflation back in the 70s. They've seen recessions. They've seen housing crises. And during that time, they have raised their dividend consistently for the past 50 years. And they've also outperformed the overall market for the past 25 years. Makes me feel very confident. That's why I put Pepsi as my 5th highest position. Number 4 is going to be NextEra Energy, NEE, which is up 3.3% on the year. Another recession-proof stock. I've been buying it as a renewable energy play. But besides that, they are Florida Power and Light, which is one of the largest energy providers in the United States. This is not something that is going to decrease depending on a recession. People still need to heat their homes and power it. And so they have the growth opportunity of being a large utility provider, but they also have the green energy potential, and that makes it really exciting. They currently pay a 2.05% dividend, outperforming the S&P 500 significantly since 1995. So this is one of my favorite stocks overall. This is a key part of not only my dividend portfolio, but also my retirement account, which is more focused on growth and renewable energy stocks. The number 3 is going to be AbbVie, which is up 8.3%. For the longest time, this was my favorite dividend stock. Number 2 and 1 on this list aren't really dividend stocks, so that's why AbbVie is going to take that position. Has a 3.66% dividend and is a biopharma stock that is really not going to be negatively affected by recessions. Yes, you have the potential of people putting off medical operations and stuff like that, but they have shown time and time again that they have consistent growth. They've outperformed the S&P 500, and since their break off from Abbott Labs, they've done incredibly well, and they've had an annualized return of, I'm pretty sure, over 20% since they did that back in 2012. Just an incredibly impressive stock, and why it's one of the backbones of my portfolio. Number 2, we're going to have Microsoft, which is down 21% of my portfolio. You might look at that and go, what? Why? This was a stock that was brought over from my previous investing strategy, and I just haven't bought since then. So this was a huge part of my portfolio going up to the start of 2022. I just haven't bought any more going into this year. The only stuff that I've bought from Microsoft is the dividends being reinvested. Microsoft is not a high-paying dividend stock, so as a result, my dollar cost averaging has not been great. This is something we're going into 2023. It's going to be on the top of my list of stocks to buy, just so I can lower that average price, dollar cost average, and I expect that when the market does recover, it's going to slingshot up, and it's going to be a huge player and the reason why my portfolio is going to outperform the market in 2023. And then finally, we have QQQ, which is the largest portion of my portfolio, which is down 14%. This is a play that I don't care if it's down in the short term. QQQ, for people who don't know, is an ETF that follows the NASDAQ, which is the tech-heavy index. This is the index that has been killed so far in 2022 because these tech stocks were the high flyers of the past 15 years. So they had a lot of gains that they were going to sell off. As a result, they've sold off more aggressively than the S&P 500. And so as the stock market goes down, I continue to buy. NASDAQ has an incredible track record of being the top performing index overall. While things might change in the upcoming future, the innovation and tech that we've seen in the past 15, 25 years has been incredibly impressive and makes me feel very confident this should be the backbone of my portfolio. It's not going to be paying an incredible dividend, but this is something where when the market does recover, it's going to shoot to the upside very aggressively, and that's why I want it to be the largest part of my portfolio. And anytime I have enough money sitting around where I can buy a full share, considering I cannot buy fractional shares of ETFs on Charles Schwab, I make sure to do that, and that's why it's my largest position going into 2023. So these are my 5 largest positions. I'm going to make a full video talking about every stock that I own in my portfolio just because I want to talk about the thought process and how I diversify my portfolio to make sure that as the stock market falls, I'm not going to be in a really dangerous spot where my portfolio is falling further than the overall market. That's something we're going to try to avoid at all costs. And that's kind of where I'm at right now. I think dividend stocks are going to be the way to go going into 2023 until things change. As we go into a likely recession, the high inflation period, I think these recession-proof stocks that I've mentioned so far in this video are the ways to go, and that's why they are the backbones of my portfolio. So let me know what stocks y'all are buying going into 2023, and let me know how your portfolio has performed in 2022, if it outperformed the overall market. Thanks for watching. My name is Andy. If you'd like to follow more content from me, a video will pop up on the screen right now, and if you want to see more videos, you can hit that subscribe button so you'll be notified the next time I post a video. Thanks for watching, and I will see you in the next video.